Hey, Tyler, I know we've spent a lot of time beating up on Plug Power, but frankly, there's a reason. This is a business that's really struggled to generate any value for investors over the long term. And its latest press release, they're touting a deal for an equipment lease platform. I'm going to show why I think it's another warning sign and why investors should look elsewhere if they want to make money in hydrogen. You ready for this conversation?
I feel like we take a lot of time trying to dissuade people from this very popular company.
We don't hate Plug Power. We just see we love investors and we want to help people make better investing decisions and stay away from the bad eggs like Plug Power. I'm Jason Hall. This is Investing Unscripted. He's Tyler Crow. This video is sponsored by The Motley Fool. We've got a couple great stock ideas we're going to pitch for you here. And The Motley Fool has a great offer for you as well. Go to our special link. It's fool.com/unscripted. Go to that link and you can get access to The Motley Fool's 10 best stocks to buy right now. Go check it out. You'll be glad you did. Okay, Tyler, I'm going to bring it up here on the screen. This is the latest press announcement. Came out on September 19th. Plug Power launches an equipment lease financing platform, is targeting greater than $150 million from a combination of debt leverage and customer financing solutions. On the surface, Tyler, this looks like, oh, we're partnering with somebody that's going to be our leasing partner. Here's really the key right here. As a first step, Plug signed 3 separate sale leaseback transactions equivalent to $44 million with GTL Leasing. Okay, so Tyler, what is this?
Sale leaseback. It's actually a pretty common thing we see in real estate. And
Right.
so I'm going to use that as a comparable. Basically, if I'm a company and I own my real estate and I want to free up some capital to go do something, I sell it to a real estate company and then I lease it from that same real estate company. It gives me a big infusion of cash early. And then all I have to do is pay an operating lease on the asset. So it's a quick infusion for cash, take some capital off the books and help to juice returns. There's obvious reasons to do it. And then there's also the desperate reasons for do it. And it's you need a quick grab of cash. And unfortunately, that probably is more likely the case here with Plug Power than a trying to build a more capital efficient system.
Yeah, no, I think that's exactly right. So I'm going to bring this up on the screen. This is since September 19th. The market has certainly not reacted very favorably to this latest announcement. And then we look at it over the past year, stock's down a ton. We look at it over the past 5 years from this massive run up peak. Company was smart, raised a ton of money here. But again, they have absolutely burned through that cash on the way back down. And the issue, the core here, and the reason why I agree with you. So there are definitely some smart reasons for businesses to do sale leasebacks and to change their strategy around the assets that they own. You want to focus on what you're really good at, and you find a good partner. You can now outsource that to your partner. In the case of what is happening here with Plug, I think you're right. It's a business that is simply capital starved. We've seen so far this year alone the company has added, I don't know, somewhere between 25 and 35% of their shares outstanding in new shares. Again, on the way down. I want to highlight that on the way down, the company has issued a ton of new stock at about $2.40 a share. They issued a lot of that stock because they're running out of money, I guess is the best way to put it. So there's some things about it that would make sense to have a long-term leasing partner. You get paid immediately when the equipment goes out the door. The leasing partner buys it, and then they lease it to the customer that's going to be utilizing the equipment. This feels very much like like just a desperate move to get more capital in the door. That's for sure. Okay, we've done enough beating up on Plug Power, dunking on it. I know there's some people watching this video right now that are getting angry, and you're going to comment to us in the comments. I know it. It's okay. Fine. Go ahead. Yell at us all you want. We're not attacking you. We're pointing out the problems with this desperate company that really needs to do as much as they can to raise money. Let's give some better ideas, Tyler. You go first. You've got one for investors that are looking for a stable, surefire way to make money in industrial gas that also just happens to be companies that have billion-dollar hydrogen businesses already.
Yeah, I don't want to. We don't have to hide it too much. Company I want to talk about is Linde. It's one of the world's largest industrial gas companies. And if we talk about hydrogen as an industrial gas, we've talked about it as this kind of the salvation for energy and kind of this new way of doing low carbon power. But hydrogen as an industrial gas has been around for decades, and the actual process of producing hydrogen has been around for decades. The newer process is using electrolysis, which is the green hydrogen
Green
movement.
hydrogen, right?
Yeah, it's still in its nascent stage everywhere, but Linde does have these operations and they're working at it. But on top of kind of this upside play in terms of hydrogen, you have this very unstable industrial gas that sells to everybody. They have to sell oxygen to medical facilities. They sell industrial gases like CO2, hydrogen, oxygen to industrial manufacturers, light bulb companies with like noble gases and things like that. There's this very wide variety of industrial gases that are available. It's a high return business that has been for decades churning out 15% annualized returns. Now, it doesn't quite have the lottery ticket success possibility that I think people who are investing in Plug Power are looking for. But if held over a long time, 15% is substantially beating the market. And the longer you hold, the longer that beating the market starts to really take place. Linde is not ignorant to the idea of hydrogen energy being a real solution too. Despite not having a lot of investor material at the Linde investor relations site, they do talk about they see a $50 billion investment opportunity, not $50 billion market opportunity, $50 billion of investment. And that kind of gives you a rough idea that this is a company that is going to take this seriously. And look, if I had to bet who's going to be the better producer of like cheap hydrogen gas and serve their customers well, I got a feeling Linde is going to eat Plug Power's lunch.
The bottom line is that we've seen that already. So this is a chart looking over the past 10 years. So again, almost 16%, 15.8% in total returns annualized versus about 13% for the S&P 500 of the same period, 333% in total returns. Just for clarification here, I'm going to put Plug Power on here because a lot of people think about Plug Power and they think, oh, it's this new upstart business. It's the new thing. No, they've been around for at least 10 years. So again, 10-year period, lost investors 55% versus a 245% run for the S&P 500 versus 333% in total returns for Linde. Now, if we go back even farther, look where we are, going back to late 1990s. And guess what? That's when Plug Power actually went public. And the stock is down a absolute gobsmacking 99%, while Linde investors have gotten a 31 bagger. I think you're right. This is a business that's shown that it can produce, it can deliver for investors. Plug Power has only shown that it can take investor capital and turn it into less money. So investors should definitely be looking at a company like Linde instead. I've got one as well, because you know what, Tyler? I do think there are some pure play, smaller businesses in hydrogen that could be that big winner that investors are looking for from Plug. And one that I think does have some potential is Bloom Energy. I'm going to just share some quick reasons why on the screen. And what it starts with, first of all, I didn't highlight it on the screen. You can go look at some of the other videos we've done. Plug Power's business is in decline. They're not growing sales in any of their core areas. Sales are declining. You look at Bloom Energy, revenue in its second quarter was up about 12%. So that's good. Gross margin getting better. Operating loss shrinking. So we're actually seeing some signs of a healthier business from Bloom Energy. Now, still burning money, but it has money. It has cash. It has resources on its balance sheet to fund its efforts to continue to expand, take on market share, and grow and get to the point where it's generating positive cash flow. So again, it's not super cheap. It's like on a per share basis of less than $2, like Plug is. It's about $10 a share. So I know a lot of investors say it's only $2 a share. It could go back up to where it was. Like, guys, there's like twice as many shares now as there used to be. Plug has flooded the market with new shares and keeps cutting the pizza into smaller and smaller pieces. If you want to find a pure play startup, more like a startup business that has potential in hydrogen, please look at Bloom Energy before you look at Plug Power any closer. And if you really want to be super smart about it, think about diversifying your risk. Tyler's exactly right. A business like Linde, they've been doing hydrogen for years. They're moving into green energy, green hydrogen, and they've demonstrated the ability to create value for investors, help grow your wealth, and make money year in and year out.